Hi, I'm Brad Simmerman, and welcome to Street Check. This week, the best one-person podcast in the history of Cabot Wealth Network. My normal co-host, Chris Preston, is on vacation, so we are going to be flying solo for the first half of the pod, and then at the end, we're going to bring on Nancy Zambell of Cabot Money Club. We are going to take some time to talk about housing, talk about the real estate environment in general, what people can do that are stuck in rates that are stuck at high rates that they may not love. Spoiler alert is not a lot, but she's also going to give a couple of stock recommendations to take advantage of the market as it is now. But before we get there, I wanted to spend a little bit of time going through some of the news this week. We've had a lot of earnings blowups, especially among software names, but we've also had a lot of companies come out and beat and just skyrocket. Um, Given that it's this first half is sort of a solo pod, I don't think you want to listen to me just sit here and drone on about earnings numbers. So I think we're going to have to talk more about earnings next week when Chris is back. But I didn't want to avoid the news entirely because we did have a couple of big news items come out. To begin with, we've got ISM Services. We also had this week's initial jobless claims, which are not particularly notable, but they're the first jobs numbers we've seen since we had last week's little mini meltdown on what looks like a weakening economy. And then we also had tariffs. Those were actually implemented. So we did kind of avoid the perpetual can kicking that we've seen so much of. And then I wanted to flag a couple of news items that are interesting and that are crypto related, but aren't super actionable. So let's go ahead and start with ISM. The ISM Services Index report earlier this week triggered some selling pressure in the early week. The survey results showed a 50.1% on the ISM Services. That was down 0.7%. And the expectations were that we'd get a 51.1% reading on it. Anything below 50% is considered contractionary. So a 50.1 is just knocking on the door of that. It's not catastrophic. It's not an immediate, it's not triggering a recession and fears of an immediate recession, but it is sort of carrying on what Chris and I were talking about last week, which is signs of slowdown, maybe a little bit of structural weakness in the economy. It's not panic worthy, but it is worth paying attention to and watching going forward. As part of that, two numbers stood out. Prices paid were the highest in 3 years. So that gets to some of the added prices of, say, tariffs, sort of matriculating through the economy. And then the employment element of the survey was the lowest in 4 years. So weaker hiring, jobs numbers aren't phenomenal, and that's a continuation of that trend that we talked about last week, where under the surface the job numbers are not as great as hoped, but they're not as bad as feared yet. If you recall last week, we mentioned that the GDP growth, if you control for imports and exports, is something like 1.2% so far this year, which is growing, but it's not a barn burner. It's not phenomenal growth from the economy. And the ISM Services Index was sort of in line with that framing of the economy. So still holding up, still resilient, a little bit softer than people would like to see, but we're not in a recession right now that nobody's missing. So this shouldn't be a huge surprise. And honestly, it really wasn't. The market has largely taken it in stride. As of yesterday's close, the Nasdaq was up 0.6% from Thursday to Thursday. So that's before the market sell off at the end of last week through yesterday's close. And the S&P was flat. And in that time, we've also had the implementation of tariffs. It is still very much a moving target for not just investors, but for counterparties. Um, Japan is allegedly investing $600 billion in the US, and there seems to be a conflict between how our leadership, the US administration, is treating that 600 billion in promised payments versus how Japan is treating it. Um, Switzerland strangely got a 39% tariff implemented, including on gold bars in excess of 1 kilogram. But the administration has also had, talking points that these tariffs may be in place for a few days or a few months or a few weeks. So it does seem to be a baseline pending what could be maybe better results or ongoing negotiations. Um, because it's been such a fluid situation, it's really tough to set any kind of particular expectations for what the tariff rates are going to look like going forward. I'm largely of the same opinion I was last week, which is the tariffs aren't going to get blanket rolled back absent a court order. They are a funding mechanism, or at least they're being approached as a funding mechanism. And given that the one big bill passed, I don't see a pathway towards removing tariffs as a government funding mechanism. I mean, I suppose if you had more widespread government services cuts or something along those lines where you're getting really material savings, that that could maybe do it. But for the time being, I think most people are best served approaching these tariffs as a permanent policy, but with maybe a floating rate or a moving target rate as as negotiations develop. And thus far, a combination of like businesses that are passing it through, um, foreign exporters that are maybe taking hits to their margins, and then consumers that are paying a little bit more. We've sort of made it work. We're muddling along. The economy is muddling along. There is a little bit of weakness in the investing world, though, just because the market has really narrowed. The rally that we've seen for the last couple of years has sort of reverted to that narrow leadership that we saw last year, which, in hindsight worked out really well for investors because markets are all materially higher, um, albeit a lot of that is being driven by Mag 7, big tech, um, the S&P equal weight, which is something that we talk about periodically, is up only 12% since November of 2021. So that was when we had the all-time highs before the 2022 bear market. And as of right now, about half the stocks in the S&P 500 and the NASDAQ 100 are below their 50-day lines. It's something that Mike Santolo has been flagging to his subscribers. Um, Again, it's under the surface weakness and it's just less than ideal conditions, but it's not throwing up red flags. We'll talk about this when Nancy joins a little bit later, but I think the consensus is cautiously bullish, and that maybe we see a little bit of weakness here. Chris has said he expects maybe something like a 5 or 8% correction in the coming months. That's certainly a possibility. I'm more macro focused and looking to see maybe what inflation looks like, what the Fed decisions are, and what the labor market does in the coming months. But I don't think anybody's going to be stunned by not even a full correction, but a little bit of a sell-off. Seasonally as well, September is historically, like right after Labor Day, is a weak period for the market. August is one of the weaker periods for the market. You've got Wall Street coming back from vacation and reassessing where things stand going into the back half of the year. So good, not great, I guess, is the big picture takeaway for the market right now. Even as we speak, the S&P and the NASDAQ are trading higher today on Friday. So, uh, you know, overcoming the implementation of tariffs, overcoming that bad ISM services print, those are all good things and should be viewed as such. We also got initial jobless claims, 226,000 this week versus expectations of 221,000. And again, it's not a catastrophic level. It's very near the target. It's just a little bit above target. It reinforces something that Jerome Powell had mentioned, I guess, in a presser maybe 2 months ago, where what we're dealing with right now is a low hire, low fire market. So something of a stagnant job market. We are seeing some layoffs from big tech, although the passage of the big beautiful bill is actually good for that because of how it treats R&D spending and employment spending. That should actually help shore up jobs numbers a little bit. That was sort of a cliff that was avoided. And a low hire, low fire environment is, again, good, not great. Like the low hire part is not phenomenal. It doesn't speak to a ton of growth under the economy as a whole, but it's also not particularly worrisome. We are very much in a period that's being driven by big tech. There's still uncertainty. Hopefully, with the implementation of tariffs now, we'll get a little bit more certainty, and businesses are going to be able to project what their costs are going to be. Consumers are going to be able to resume buying based on the price of goods going forward. So it'll get the data will get less lumpy. I don't think we're going to see the mass imports and and then complete slowdown of imports. Consumers are sort of normalizing to the environment that we're dealing with now. So it's cautious bull market. The last item that I wanted to bring up before we bring on our guest is a couple of developments in the crypto space. The SEC approved in-kind redemptions for spot ETH and or Ethereum and Bitcoin ETFs. So that allows big institutional investors that own something like an IBIT, or another Bitcoin ETF to actually just redeem the ETF in kind and then take delivery of that asset. It's notable because in-kind redemption can smooth liquidity in ETFs, instead of having to sell IBIT if they want to move out of a position. They can just take a redemption in kind and then parcel it out or reallocate their holdings. Um, we also saw spot futures contracts approved by the CFTC. That's the Commodities Futures Trading Group, for Ether and for Bitcoin as well. I'm going to be watching Coinbase and some of the other Bitcoin focused guys, like, somebody like a Robinhood who trades a fair amount of cryptocurrency, just because trading futures directly on exchange removes one business segment, sort of one avenue for them to do business. But that's counteracted a little bit by the in-kind redemption. I'm presuming Goldman Sachs is going to work with, or, a big buyer, somebody like that, will work with the institutional arm of somebody like Coinbase rather than fully self-custody in-house. I could be wrong on that. So it's a little bit of mixed news for some of the crypto players, because you've got a drop potentially in volume because you can now just trade futures directly instead of having to trade in and out of Bitcoin or other assets that are Bitcoin analogs. But then you've also got the potential for more direct custody. So very much a mixed bag. Just something to have on your radar. Obviously, we've had a lot of crypto-friendly news. I believe there was an executive order signed in the last couple of days that allow for 401ks to increase their exposure to assets like private equity, crypto. I don't particularly love it. I don't love having an asset that's as volatile as crypto in a retirement account, just because it's so hard to replace retirement assets. There are contribution limits that are in play. So if you take a $50,000 loss because Ether has a bad week, or Bitcoin craters or something like that, it's really hard to get that loss back in. It's a different story if it's in a taxable account or if it's just cash that you've got on hand, right? You still lose the same amount of money, but it's much harder to take advantage of the tax advantaged element of the retirement accounts. So mixed bag there. Crypto friendly week in general. Watch guys like Coinbase. Look to see if they're starting to generate more revenue from the custodial services and maybe less trading revenue. Because if we get legislation that is so crypto friendly that it becomes as simple as trading stocks, somebody like Coinbase could suffer in that environment because we don't need that third-party intermediary that's facilitating all these trades. All right, I think that'll do it for news this week, and we'll bring on Nancy Zambell in just a second. But before we do, I wanted to highlight this week's offer for listeners, which you can see by going to cabotwealth.com/street. This week, we are offering a 65% discount on Cabot's Small Cap Confidential. That's one of Tyler London's advisories. He's been on the podcast frequently. It specifically targets small cap stocks. Tyler's rationale for buying small caps is great. You've probably heard him talk about robbing the train before it leaves the station. The idea being that you identify opportunities for smaller cap companies before big institutional investors even have them on their radar, because the big institutional investors are subject to limitations to what they can buy. Warren Buffett has talked about mosquitoes versus elephants, right? Like when you have a multi-hundred-billion-dollar portfolio like Berkshire does, you can't buy $10 million worth of a small cap stock. You need to buy $1 billion worth of something that can support $1 billion in volume. So there are a lot more opportunities for individual investors in small caps that you just can't find in large caps that already have the big institutional, the big investment bank, hedge fund, 401k sponsorship. So this monthly advisory, it's 12 issues, so you get a monthly issue, also access to some free special reports, including the infrastructure-focused mini Berkshire. Speaking of Berkshire, you haven't heard about Truth About AI Stocks. And again, that's $697 for 1 year. That's a 65% discount from the normal price. So if you'd like to learn more about that, visit cabotwealth.com/street. And we will be right back shortly with Nancy Zambell of Cabot Money Club. All right, we welcome on Nancy Zambell of Cabot Money Club. She is joining us today. Going to talk a little bit about stocks, going to talk about housing, and then maybe leave us with some picks. Nancy, thank you for joining us. And how are you doing today?
I'm good, Brad. Thank you for having me. How are you doing?
Good. Busy. As podcast listeners may be aware, my co-host and the other primary editor at Cabot is out this week, so picking up his slack as per usual. But
I'm recording this.
we're all recording this. That's the point of the podcast. It's in perpetuity. Part of the reason that I wanted to have you on is because, we focus a lot on for a lot of Americans. It's like the primary method to build wealth for a lot of middle-class families. So I wanted to carve out some time for us to talk about housing. Before we get there, though, I wanted to get your thoughts on the market. Obviously, we're at or very near all-time highs, but there's a little bit of softness under the surface. There's some earnings blowups that we've been seeing. What's your big picture, 10,000-foot view takeaway of the market right now?
Well, my crystal ball doesn't work very well, but I look at a lot of things. I look at valuation for one thing, and the PE of the S&P 500 is around 22 now, which is above the 19 that it has been for the last 10 years. So it's not terrible. I've seen it much worse in my lifetime. It's probably a little toppy. I mean, sentiment has gotten a little bit more bearish in the last week, the last month, actually, with both the individual investors and the institutional investors. But I think it's just a pause. I mean, I don't see anything. I mean, we look at what the tariffs have done. I wrote a couple of articles early on the whole tariff issue, and people were very, very worried about the earnings. And then we got earnings and not much happened. Now we got earnings again. Not a whole lot has happened, though there have been some blowups, as you said. Who knows how it's going to end up? If we knew what the president was actually going to settle on, we could forecast what that was going to do, especially to the multinationals. But no one knows that. He probably doesn't even know that. So I just think we just take it as it comes. I'd be wary maybe about investing in some of the multinationals because of the tariff issues, and especially people that do a lot of their business in Asia. That's going to be an issue. But there's positives and negatives about the whole issue. And the positive is that we are bringing some manufacturing back to the US, which I think has been long due. Unfortunately, that also is going to raise prices because
Yeah.
people here are not going to work for $2 a day or $2 a week or whatever it is. But long term, I think the market is still in pretty good shape. We've gone a long time without a recession right now, and that's always in the back of my head. What's the next shoe that's going to drop? But I don't see anything, unless these wars escalate.
Yeah. But let's obviously hope not.
Yeah,
I did see that Vanguard is recommending a 70-30 bonds to stocks portfolio. And some other big banks are also sort of warning about the market being highly valued and rather than I think seeing a correction coming in, a sharp, steep drop off, they're seeing more of a plateau that could lead stocks to underperform for the next few years to come. Vanguard is not a market timing
right.
service or their institutions aren't focused on market timing. They're looking at longer term allocations, but yeah, valuations still elevated, which
Hmm.
frankly, is a good lead into what I wanted to talk to you about, which is housing, where valuations are still pretty high. What's your knee-jerk reaction to the housing market in the like at this moment?
Well, I'll tell you, I was just in a class all week long with other realtors from across the country. And it's so interesting to hear what different regions are doing because real estate is very localized until you get some big bump that drops everybody. Right now, for instance, in New York, there's still very much a seller's market. Here in Tennessee, it's turned into a buyer's market. Our inventory has increased. Our prices have actually started declining. Nationwide prices have only gone up 2.3% in the last month, which is pretty low compared to usual. But historically, on a long-term basis, real estate prices usually only escalate 3 to 5% a year. So 2.3 really isn't bad, but the buyers have dried up. And we're seeing that all across the country because of interest rates and just because of housing prices. But I'm starting to see a lot of price reductions, not only in my area, but in other areas across the country, because things are still elevated. On the new listings, people are still trying to get the old prices they could get 2 years ago. That's gone. You're not going to do that anymore. Although in our market in Tennessee, some 44% of people the sellers are still getting the list price or above at closing. So they're not, you can still negotiate, but list to buy price is still like 99%. So, that's still pretty healthy, but business has slowed across the board.
Yeah, to that point, I saw that in June, 26.6% of sellers nationwide had lowered or were selling at a price that was lowered from the initial listing price,
Mhm.
and then inventory's highest since November of 19.
Yeah.
That's certainly been capturing headlines. The phenomenon of owners rather than accepting lower prices, just pulling them off the market, partially because a lot of people are still sitting at, sub 5% loans. That's 70, just some statistics I had coming into this. In Q1 of 22, 85.6% of mortgage loans outstanding were under 5%. As of the end of the first quarter of this year, that's down to 71.3, but that's still a lot of people that are
Huge.
are really that are homeowners at historically low rates. So have you seen an uptick in people that were home buyers that have become sort of accidental landlords?
Yes. Yes, people. In fact, I was just talking to the guy that owned this house down the street that he bought for a cheap price and flipped, and it was. You're going to laugh because I know your market is more expensive than ours, but he listed it for 420. It was 1,600 square feet. It just sold for 370. But he was considering renting it out. He didn't want to, but it had been rented before he bought it. But yeah, people are doing that. I just spoke to a lady this morning who's been looking for a house, and she's like, well, we can't really find anything. So now we're thinking about renting, but we can't find anything renting either because rentals have gone up and prices are still escalating a little bit in the rental market market depending where you are. I have a handyman who owns 19 rental houses, and he tells me that he's still getting elevated prices on his rents, and they're all 100% occupied. So, but inventory's increased. It's helping the market, but it's still 4.7 months nationally. Here in Tennessee, it's 6.16 months of inventory. So, but rates, as you know, have come down this week. In fact, this morning they were down to from 6.58 to 6.74 like the beginning of the week. Then they dropped to 6.63. Now they're 6.58 for a 30-year fixed on average. And that's the lowest since last April. So that is going to help the market. People are starting to refinance, which is a head scratcher because I don't know what kind of mortgages that they have that they would refinance for 6.5%, because you've got all of these under 5% mortgages out there. But what I am seeing are member assumable loans.
Mhm.
I'm seeing some of those show up on the listings. Now, mostly those are FHA and VA type loans. Most conventionals are not assumable, but I saw one yesterday for assumable at a 2.2% rate.
Yeah, that's phenomenal. Like, if you have that as an out,
Right.
you jump through every hoop you have to be able to transfer that because one of the things that the new builders can do is offer rate buy downs, offer incentives that aren't. I mean, yes, technically, if I'm a private seller, I can probably finagle the numbers a little bit to give you something that's equivalent to a rate buy down, but I don't have the kind of latitude that new sellers do. Um,
Now, in construction, that's down. Housing starts are down 0.5%. Building permits are down 4.4% over last year. So, and those are national statistics too. So I'm still seeing houses going up, but at a slower pace.
So if somebody was a buyer in, let's say, like the last year and a half, right? Something that you and I have talked about in the past is the marry the house, date the rate, where I think a lot of both on the investor side and on the retail side, a lot of people expected interest rates to come down a lot quicker because we'd really been accustomed to near zero interest rates across the board. So marry the house, date the rate was pretty popular for a while, although I presume that has slowed a lot in the last 6 to 10 months as it's
Yeah,
become sort of evident that.
at the end of last year, the economists were predicting that the 30-year mortgage rate would be 5% by the end of 25. Now that rate is around 6.2% for the forecast. Um, People were hoping that maybe by 2026, the end of 2026, we'd be down at 4%. I don't know that we're ever going to see 4% again in our lifetime. I would be shocked if we see it in the next 10 years. So I think somewhere probably in 2026, it might hit 5.5, from what my sources tell me. But I think we're going to be kind of stuck in this for a while. But I think that when people start to realize that, hey, this is it, you can
Mhm.
wait around for the rest of your life for it to go back to 2%. We're never going to see it again. I would swear on a stack of Bibles for that. But you have to realize that historically, 6% is still a pretty darn low rate. The first home I ever bought, which I'm not even going to tell you when that was because it will date me, but it was at 14%. And I refinanced it a couple of times. I think my last refinance, I got to 8, and I was tickled pink to have 8%. So, it's all relative. You've got to do the numbers and see it doesn't make that big of a difference in a monthly payment unless you're in a really high-end home. But of course, high-end home buyers usually have a lot of cash to put down too. And
Right.
sometimes the whole deal is cash.
So what
What was your
is
question? I think I lost your question in there.
Oh, so if I'm a home buyer or if I'm a homeowner that bought in the last couple of years and I'm sitting at 6.75 or 7% mortgage rates, what can I do?
Not
I
much, because the rule of thumb for years has been that you need to lower your rate by 2% in order to really change your monthly payment a lot. I mean, sure, every percentage down does change the monthly payment, but you also have to look at the refinancing cost. You've got refinancing costs. So you could think about doing a lease to buy type deal. If you really want to get out of your house, talk to the buyer and say, would you lease it, and give the buyer some time to say, well, okay, when rates get down to 6.5 or, 6.25, then I'll be ready to buy. In fact, I made an offer like that on a house out in Arkansas a couple of months ago. The seller was not ready to do it yet. But one of the things that for the buyers is just tell them I'll give you a substantial non-refundable down payment. Let me lease this and see what interest rates are going to do for 6 months, and then I will buy it at this price. And the stumbling block with this one was the price I wanted to pay for it was not the price they wanted.
That that leads me to something that I don't think you and I have talked about, adjustable rates. Are people considering I mean, I
Well, they're
remember
not, the rates
'08.
aren't low enough yet. I mean, typically, oh my gosh, I was selling mortgages back when we had negatively amortized loans a long time ago. And back then they started with, the adjustable rate mortgages, and the rate was considerably lower than the 30-year fixed. It is not today. You might get a 1% lower. So you've got to balance. Is it worth the risk to do that? How long am I going to be in the house? And the adjustable rates are much healthier today than what they were 30, 40 years ago. But still, you've got to look at the cap of the rate, and you've got to look at how much the adjustment can be and how often the adjustment can be. Because if I could get an adjustable rate today for about 5.5%. But then when I go to refinance it to a 30-year, my gosh, the refinancing costs, you're talking thousands of dollars, $7,000 to $10,000. So you have to do the numbers. Now,
Right.
if the adjustables go down to 4, then I'm going to get serious about it.
There had been a lot of talking points, I think, last year that like 5% was the magic number, where that's the number where if mortgage rates hit that level, the housing market unthaws entirely and everybody's sort of back to business as usual. Is that consensus number? I presume it would be higher now. What is it, like 6% now is the number that they're
No,
looking
I
at?
don't pay I don't pay any attention to those numbers because they're meaningless. There's so many more things that go into the mortgage market and pricing of houses. And that rate, as we just discussed, is historically still very low. So I don't think that's it. I think it's prices. I think
Yeah.
that's the major thing. I mean, this house that I had made that offer on, they've lowered it by $15,000. It's still about 20,000 above market prices. People are just being really stubborn, and it may just be because that lady who owns it, or man, whatever, has a high mortgage on it, and this is what she can afford. But
Mhm.
you get stuck in that. People like that are probably going to end up having to rent. But then the question is, can you get enough of a rental income off of that to be more than your mortgage payment and your insurance and all the other stuff you have to pay?
Yeah, it sounds like, maybe a year from now, once those accidental renters or those accidental landlords have gone through sort of a rent cycle, that there may be some natural thawing then. Um, there was another number that I was looking. Oh, the price to rent ratio is something that I remember looking at really closely back in '08. You know, nationwide, I think it was as high as like 25 times the annual cost of renting. It's still really elevated in a lot of major areas. So, um, in a city like San Francisco, a 25 price to rent ratio is affordable because the property costs are just so high. But nationwide, that 16 range is typically considered around fair value, or when it makes more sense to buy. Um, do you do we need nationwide prices to come down, or regional regional movement going to be enough to get sort of hot spots in the housing market, do you think? Where if,
No, I think it's going to have to be nationwide. And the reason is that filters down. It's like decorating trends. I used to live in California. That's where you go for the latest in design trends. And it takes a while to filter into the Midwest and to the South because, way back 25 years ago when I was living out there, they had things like 24-foot ceilings, and we never had any of that kind of stuff around here, you know. So now that is changing. It's the same way with the pricing and rates. I don't think one region really can't, even though real estate is local on a long-term basis, it's really not. I remember years ago in 2007, the broker that I was working for at the time kept saying that real estate's local, real estate's local. We're not going to be impacted by all these subprime mortgages. Well, that's bull because it ends up impacting everybody. And the same way with the prices now, if New York City suddenly collapsed, New York, San Francisco are sort of two different places in terms. You can't compare those to anywhere else in the U.S., maybe Chicago. But, New York has gone through those major real estate cycles where, gosh, you could practically buy anything for anything up there because it was so cheap. And then the next time you look at it, everything is so ridiculously expensive. But if things change in San Francisco or New York, that will eventually filter out. But if things start changing in Omaha, and they start changing in Minneapolis and El Paso, Texas, that means the biggest part of the country is going to change too, because we're all sort of in that same middle
Mhm.
class boat.
So I guess to sort of put a bow on it, what are your marching orders for people that are maybe renting now, looking at buying? Is it give rates a little bit of time to come down? I mean, obviously the Fed rate cuts and, they don't control the long end, but if prevailing rates are coming down, then hopefully that's going to be beneficial for housing as well. What's your recommendation to somebody that's renting now that's maybe looking to buy in the next year or two?
And this sounds silly, but really get a good realtor. I mean, because we have access to all of these databases. I mean, I've just seen two in the area I'm looking at in Arkansas that were just no brainers. If I had been there and been ready to buy, I would have scooped them up. I mean, both of those houses went within one day. That's not the way the normal market is right now. So you've got to find somebody that can help you spy those opportunities, because the average person, you can look on Zillow all day long or realtor.com, but you're not going to see what a good realtor is going to see who can help you get that bargain. I mean, I just give you a quick example. I had a customer a few years ago, and he was looking for a property to build a new home. And I lived on a big lake at the time, and not everybody on the street was on the lake. The lake ended at this one particular house, but next to it was another lot which had access to the lake. And if you got in there early enough, you could get the HOA to allow you to build a dock on it. So this lot was for sale with that house at the end of the lake. They priced it at $25,000. At that time, it should have been 65. I called my customer up. I said, "You have to buy this today, or I'm going to buy it and then I'm going to sell it to you for 20% more." Because it has access to the lake, but it's wooded. This is exactly what you wanted, and it's way underpriced. And he did. He ended up buying, and he sold it a few years later after he built his house on it. But it's that kind of thing that if you're working with somebody who knows what they're doing, but those are also few and far between. You're not going to see them every day. But if you have a good realtor and a good lender, they can get together and help you decide what's the best road that you're going to go. Because maybe it's better to do some kind of an equity line and go into a new house. Maybe your mortgage is assumable. Most people wouldn't even know that. You'd have to go to your lender and ask them about it, because who reads all those papers when you close? Nobody, except for the attorneys. So, I mean, it's almost impossible for an average person because everybody's got a job. That's not their
Yeah.
job to be out there looking. But like this little house down the street that I was just telling you about that they sold for 370, they originally listed it, the last people who owned it, for 420. It went for 200. So, yeah, it needed to be totally redone. But the guy put
Yeah.
60,000 in it and he made a bunch of money.
Yeah, it sounds like thawing a little bit, not a buyer's market yet, just because prices are still high, but it's getting closer and that
It's,
there's
yeah,
opportunities, but to spot those opportunities, you need to be on top of it. So,
yeah,
if you're retired and just driving the streets of your
mm,
town and you see the person hammering in the for sale sign, maybe
yeah,
you can do it. But if you are a working professional and your days are taken, work with somebody that's going to have their eye on the market at all times to
Yeah.
spot those opportunities.
Yeah, because the agent is going to do a search for you and it's going to show you. I mean, I get a search every day for Arkansas and it's going to show you all the homes that have been listed that day. And,
Mhm.
you can jump right in. And I mean, last time I was out there was in May and I said to my agent, all these houses are just seem overpriced to me. What do you think? Because it's his market area. And he said, I totally agree. Most everything was like 30 to $40,000 higher than what it should have been because people were still sunk in that mentality that I can get COVID plus prices, and you can't do that anymore. I mean, real estate is going back to normal.
Mhm.
Now, all the new agents don't want to hear that because they made a lot of money in the past few years, but now it's going to be normal, you know?
So it sounds like sellers are still waiting on those COVID sort of peak prices, and buyers are still waiting a little bit on those COVID like rock bottom rates. And it sounds like we sort of both sides need to reset their expectations for what the market's going to maybe look like in the next couple of years. That would probably be that would be maybe the important takeaway for me is if you are holding off on buying because you're waiting for 3% mortgages or 4%, it's going to be a
Stop.
tough pill to swallow. But yeah, you gotta strike. If you see an opportunity, you have to sort of strike while
And
the iron's hot.
yeah, and inventory is increasing. Just the search that I have of the houses I'm looking at in Arkansas started out maybe February. There were 39 houses that met my criteria. There are 60 now.
Wow.
So, I mean, for an individual, that's a lot of more
Yeah.
houses, you know. So I'm sure that within those 60 houses, I can find something I really want.
Yeah, it certainly sounds like it. All right. Well, I think that's going to be our housing talk. But while I've got you, I just wanted to ask one last question. Do you have a stock, anything in particular that you're watching right now? Probably just one. I've taken a
Okay,
lot of
well,
your time, and I
since
appreciate it.
I've been thinking about the housing market, I'll give you two. There's an ETF called ITB. It's the U.S. Home Construction iShares. That looks pretty good. It's got a lot of the big builders in it, and then the other company is DR Horton, which is DHI, and they're really the top number one builder in terms of volume in the United States. And there's the builder stocks look pretty good. Also, Home Depot and Lowe's also look pretty good.
Well, sounds like we now have our marching orders for where to invest. All
Exactly.
right.
Go for it.
Well, Nancy, thank you very much for joining me today, and to everybody watching or listening, thank you for joining this episode of Street Check, and we will see you next week.